Bear markets can be scary. There's a lot of fear and uncertainty. And when people are unsure, they often make poor decisions. But a smart investor don't panic. They have a plan. They don't just survive bear markets. They use them as an opportunity to grow stronger. Hi, my name is Lincoln. Welcome to the channel. In this channel, we cut through the noise and share real practical money insight to help you build a strong, unshakable future in any market condition. Here are 5 things smart investors do and avoid during a bear market. Number 1. Know who you really are, trader or investor. The most important rule in investing is also the hardest one to follow. Do nothing when it feels like you should do something. Jack Bogle, founder of Vanguard, called it stay the course. He believed in it so deeply that he made it the title of his final book. And for good reason, because doing nothing isn't laziness. And investing is often discipline in disguise. Think of bear market like storm at sea. Panic makes you want to jump ship. But the best sellers and the best investors hold the wheel steady and ride it out. It's not comfortable, but it works. Data back this up. Missing just the 10 best days in the market over 20 years can cut your return by more than 50%. And when do the best days usually happen? Right after the worst ones, and when most people have already sold and walked away. Here is the key. Decide if you are a trader or an investor. Traders chase short-term moves. They try to make 2% on Tuesday and avoid 3% losses on Thursday. Investors, on the other hand, play a longer game. They understand wealth is built not by predicting, but by participating again and again over decades. A long-term investor knows the only edge that matters is time. Time in the market, time to let compounding do its work, and time to ignore what doesn't matter. In the short run, markets test your patience. In the long run, they reward it. Number 2. Master the inner game. Emotions are expensive. Markets crash. Emotions spike. Most people react. Smart investors don't, because they have trained for this. Think of smart investors like Brad Wells in Brazilian Jiu-Jitsu. To a beginner, a fight looks like chaos, scramble, pressure, panic. But a black belt sees patterns. They don't waste energy reacting to every move. They know what matters. They have felt this before. And because of that, they stay calm under pressure and make decisions with clarity, not fear. It's the same in investing. When markets fall, many investors let fear take the wheel. They sell at the bottom. They buy back once price rises. They eject objects what builds wealth. It's like tapping out from discomfort, not danger. They are reacting to the noise, not the threats. Study after study shows the cost of emotional investing. Dalbr's 2023 data reveals the average equity investor underperformed the market dropped by over 5% annually over 20 years. Not because of bad investments, but because of bad timing driven by emotion. Black belts don't react every time pressure rises, neither do smart investors. They trained their minds to recognize that volatility isn't a signal to act, it's a test to endure. They focus on what matters, staying consistent, staying invest, and tune out the noise. Number 3. Stop chasing buttons. Catching knives isn't a strategy. Trying to time the market is like trying to catch a falling knife. You might grab it, but you will probably get caught. Even the best get it wrong. In 2008, Warren Buffett wrote Buy American IM as the S&P 500 was already down 40%. Many thought he was calling the bottom, but the market kept falling another 30% and didn't actually bottom up for 5 more months. If the most disciplined investor alive can't nail the timing, why should the rest of us try? The truth is markets fall fast and recover slowly. They are moved by story, fear, and psychology, not spreadsheet. According to Dalbra, the average investor underperformed the S&P 500 by over 4% a year for the last 20 years. Mostly because they were trying to outsmart cycles they didn't understand. Smart investors don't predict buttons, they survive them. They stay in the game because in investing, time in the market always beats time in the market. And here is where it gets interesting. Once you have accepted what you can't predict the button, you stop waiting and start preparing. That leads to the next move, buy the dip. Not emotionally, not recklessly, but strategically. When markets fall, most people freeze or flee. Smart investors see value. If your favorite fund or stock is down 20% and your long-term outlook hasn't changed, that's not a threat. That's a sale. Think of it like this. You don't wait for a closing store to hit rock bottom price before buying a winter coat. If it's a good coat and it's 30% off, you buy. Same with the stocks. Waiting for the eject button is a guessing game, but buying during the fall when others are scared is how wealth is quietly built. So don't time the market, prepare for it. And when the dips comes, be ready to lean in, not because you are trying to be clever, but because you have changed to be consistent. Number 4, build a cash buffer. Optionality is a superpower. In investing, cash is like oxygen. You don't notice it when you have enough. But the moment you run out, it's all you can think about. Most people panic in a bear market because they don't have enough cash to cover their short-term needs. Having a healthy cash reserve keeps you calm and clear-headed instead of reacting emotionally. Bear markets aren't just about falling prices, they're about uncertainty. You don't know if they will last 3 months or 3 years. That uncertainty is what makes cash so valuable, not for its returns, which are barely above zero, but for its flexibility. Most people think cash is lazy. It earns little, it just sits in there. But in reality, cash gives you options. It gives you the power to make decisions calmly instead of emotionally. In a 2022 survey by Fidelity, nearly 60% of investors said they regret selling in past downturns, often because they needed cash, not because they lost convictions. Think of cash as your seatbelt. It won't make you go faster, but it will keep you alive when the road gets bumpy. Cash also turns panic into opportunity. In 2008, while most investors were selling, Warren Buffett invested $5 billion into Goldman Sachs. Why? Because he had $20+ billion in cash on hand. That single move earned him billions, not because he timed the market, but because he was so prepared. Smart investors don't keep cash because they are pessimistic. They keep it so they don't have to be desperate. Number 5, diversify or drift. Don't put all your wealth on one boat. The stock market is a great place to build wealth, but it shouldn't be the only place. Because when the tide goes out, you don't want your entire future drifting with it. Smart investors diversify not just within the market, across sectors and asset classes, but outside of it too. Real estate, cash reserves, side business, these are like boats when the main ship hits rock water. If all your money is tied to the market, a crash means your income and your net worth fall at the same time. That's fine when you are young and investing, but if you are in the drawdown phase, living off that money is a dangerous position to be in. Diversification isn't just about returns. It's about control. It gives you the flexibility to shift when one part of your portfolio is under pressure. Diversification doesn't guarantee riches, but it does build resilience. And the resilience is what keeps you in the game long enough to get rich. Thank you for watching. If you would like to learn more about why most people lose money in the stock market, check out my video in the link below. See you in the next video. Bye for now.